this week was decisive. Inflation continues to fall, defensive sectors are reaching 52-week highs. There's a mega merger happening in the energy sector, and in the container market, an acquisition could change everything. This is the overview of the market and my portfolio, concise but with real value for you. Let's start with the macro, inflation and interest rates. Currently, the US CPI is at 2.4% year over year, down from 2.7% previously. In the core segment, we're at 2.5% with a monthly increase of 0.2%, and in the core area up 0.3%. This means inflation continues to cool down. That's important because the rate cut fantasy is still alive, but it's still not a free money scenario. The Fed remains cautious for now. So the Fed remains in pause mode with rates at 3.5 to 3.75%. Rhetoric, the risks have diminished, but there is no promise of quick cuts. What impact could this have? REITs and BDC stabilization led to better sentiment, and refinancing remains in focus. As for the labor market, currently there are 130,000 new jobs and an unemployment rate of 4.3%. According to the data, the economy is robust but not overheated. No recession shock, but also no interest rate shock. Now let's turn to geopolitics, specifically in the oil sector. Iranian oil and China are under pressure. Trump and Netanyahu are increasing pressure on Iranian exports to China. This is important because oil risk premiums are possible and short-term spikes in oil prices are possible. The Venezuela complex. Geopolitical uncertainty remains, but headlines are strongly driving the narrative. Impacts are volatile upstream while midstream remains stable with a volume premium. Let's turn to Europe and to industry. The EU is reviewing the reform of free ETS certificates in Q3 2026. From 2026, the maritime ETS will also cover methane and N2O. Shipping will incur additional regulatory costs. Next, let's move to the Netherlands, specifically Box 3, tax. A new system is planned to start on January 1st, 2028. Taxation, actual returns. Why is this relevant? Signaling effect, European countries are seeking an aggressive tax base. For investors, more complexity is possible. So, just this week alone, a lot has already happened, which is relevant for the stock market. Let's continue with the sector flow. And here we can see that defensive sectors are dominating. This means that staples are clearly trending. REITs are hitting 52-week highs. In some cases, they're also at lows, depending on which sector you look at. Midstream is strong. The automotive industry is currently weak, and that fits exactly with our portfolio focus. Shall we move on to shipping now? And something has happened. There's breaking news just released today. Hapag-Lloyd is negotiating with ZIM, and that's very important. Container consolidation is now possible. Market power plus synergies. The timing is interesting, coming after the Red Sea windfall profits. The risk, if rates normalize, could be that the anti-cyclical effect I have today, EBIT at around 1 billion euros after normalization following peak years, is not a shock. It's simply a pure cycle. Himalaya shipping. Here too we've seen strong performance, meaning bulk carriers remain steady. Cash flow is positive, the stock is at a 52-week high, and dry bulk is stabilizing. Despite China, let's move on to upstream. Devon and Coterra, merger, 58 billion, 1.6 million barrels of oil equivalent per day, $1 billion in synergies. And Devon shareholders currently hold 54% of Coterra. And that's extremely important. Bigger means a better cost structure and economies of scale in US shale. But we do have integration risk and of course oil price dependency. BP is increasing share buybacks, 4 billion write-down on renewables, signaling that cash flow is under pressure with low oil prices. At Total Energies, I was impressed by a strong fourth quarter. Production exceeded expectations and cash flow is stable. Despite oil price pressure, it's actually not worth mentioning here. I'd say companies like Equinor, Shell and Phillips 66 are irrelevant in this context. Chevron is currently at a 52-week high. That means large integrated players are currently outperforming. Midstream company Energy Transfer is currently increasing its distribution with a yield of 7.4%, with 5.5 billion in capex. Growth combined with distribution, but the 2020 cut remains in the back of our minds. Let's move on to Enbridge. Here, there was a record quarter with plus 14 billion per program. Regulated cash flow and very stable. TC Energy confirms 2026. Outlook until 2028. This simply means that we currently have planning security here. REITs have now also announced dividends, including Realty Income, which is currently trading at a 52-week high, with a current monthly dividend of 27 cents. That corresponds to a dividend yield of 5%. A defensive focus is clearly visible. BP Carey, 98% utilization. Dividend has also been increased very solidly. AG&C at 12.5%, high yield but now a volatile structure. Medical Property Trust is a risk position in the portfolio because many tenants have dropped out. Since one or two tenants, let's say, have gone bankrupt, a dividend of 9 cents has now been confirmed here. Now let's move on to the tobacco sector. Here, Philip Morris is currently at an all-time high. The smoke-free strategy is working, and there are 35 million EQQ's users. India is blocking expansion, but the global trend remains intact. With British-American topic, Paco is extending the path, US growth continues, and in 2026, Altria is currently at over 6%. The cash flow machine remains intact. Moving on to pharma, Novo Nordisk has filed a lawsuit against Hims. FDA. The FDA is tightening regulations on advertising. Currently, we are seeing price pressure here, but the GLP-1 pill is very strong in the long term. Structural growth remains intact. Pfizer is accelerating the FDA review, currently at a 52-week high. Keep an eye on payout risk. Now let's move on to utilities, to Dominion. Here too, we are at a 52-week high. Regulated electricity demand is rising, driven by AI and data centers. Essential Utilities merger with American Waters has been approved. Here as well, we see a scale effect. Shall we move on to the industrial sector? There is an economic signal here. Mercedes' profit has halved, the dividend has been reduced, and margins are targeted between 3 and 5%. The auto sector is currently performing weakly. At Stellantis, there is also a multi-billion write-down. Then there's PayPal. Revenue miss, CEO change, first dividend, and Vero as an EU alternative. Sentiment is currently weak here as well, but we are really trading very close to the bottom. Now let's move on to the overarching trend. First, inflation is cooling, which means the pressure on interest rates is decreasing. Second, defensive stocks are performing well. Third, the energy sector is consolidating. Midstream and REITs are benefiting while Europe is structurally weak. But let's see what happens next week. There's President's Day, which means we have a shortened trading week. Then we have flash PMIs and lagging inflation data. And that will be important for interest rate expectations. Otherwise, I'd say let's take a quick look at my portfolio, just a brief glance inside. Here too, in sector rotation, we see capital flows over 3 months compared to the SPY. Now, on a daily basis, capital is moving out. Capital is flowing into energy, moving out of the financial sector, and flowing into industrials, materials, and staples. Capital is also flowing into healthcare and utilities, and REITs are currently seeing an increase as well. As I mentioned, with REITs, there are many sectors that I currently hold which are underwater by as much as 30%, as you know. Here too, I'm considering possibly picking up one or another position. By the end of 2026, this could simply provide support if interest rates really do start to affect REITs. Exactly, so we already have that covered. Let's also take a quick look at the analysis here. As mentioned, we have inflation at 2.3% and the money supply at 4.6%, so the money supply is growing moderately. Then, the yield curve is at 0.62%, so currently there is no recession signal here either. Volatility has increased, currently at 20.6%. Once it reaches 25%, you really need to be a bit cautious because then it becomes very volatile. The market, I think last week we were at 15%, so volatility is simply increasing here as well. That's something you might also want to just be aware of that. Otherwise, we have mixed signals. As I said, inflation is moderate, as is monetary growth. We have a normal interest rate curve, so a normal yield curve, and volatility is correspondingly elevated. And here too, we simply need to pay a bit of attention. Otherwise, things are going very well in the shipping sector and quite well in the mining sector. Energy and oil could potentially face recession risks, oil demand could decline. Otherwise, rails and pipelines are doing quite well, and BTC is also somewhat mixed at the moment. Currently, then let's take another quick look here at market cycles. So now I'd say it's a bit uninteresting how oil and the like have performed, or how commodities in general have performed. I'll just briefly skip the reading part since most people already know that. Here's a quick summary again of where capital is flowing out and where it isn't, because right now that's the case in shipping. At the moment, we're seeing a bit of a boom phase there, just like in mining, as I've already mentioned. Otherwise, special dividends. Right now, timing is a bit of an announcement month. And here in the dry bulk sector, there is a higher chance of a special dividend, just like with cruise, tanker, and LNG shipping, which remain normal, as does container shipping. And global proxy rates are currently above average, with solid cash flows. And that simply means ultimately, February is currently neutral for dry bulk rates. But otherwise, as I already mentioned, in these two segments, we have a higher probability that special dividends might even be distributed. Otherwise, we also have gold, silver, and then miners, as well as copper here, which is somewhat declining, but overall you can really see that they have performed very well. The conclusion for precious metals is, of course, that they are clearly in a boom phase right now. I think that's pretty much it for the most important data. I've actually already read out the news and reports to you. They have already been included, among other things. So, as you can see, for those who are already a bit familiar with my website, which I work on a bit and created myself, you can see it's starting to take shape now, slowly. In the dividend sector as well, things are already looking really good, I would say. Of course, it takes a little while to load, but otherwise, I would say that's already a complete compact overview for the week, what basically happened last week. Of course, this video is not investment advice. It's just my personal strategy and only my personal opinion. If you want to know more details about certain topics, you can of course do your own research, or you can also feel free to ask me questions. If this video helped you, feel free to give it a like. If you enjoy this format, all the more reason to leave a comment or a like. And if you're not a subscriber yet and don't want to miss any more episodes, especially in the hardest area, or now, especially with the weekly briefing, I would really appreciate a subscription. Otherwise, as always, I wish you successful investing. See you in the next video.